What is up, brother? How are you doing? Today it's going to be a shorter video today. Just going to be premium and discount. It's going to go along with the whole model, but it's not an indicator. It's kind of something that we can use to go based off our bias. So pretty much we are going to learn, and I'm going to teach you how to properly identify premium and discount using a dealing range model. And this can completely change your entries. And this is one of the more important lessons because premium and discount is a big thing inside of this trading model. So, first of all, what is premium and discount? The way that you can think about it is premium is where you want to sell because that is where price is high, and discount is where you want to buy because price is low. And the way that you uh, identify where these locations are is a dealing range. A dealing range is, as you can see up here, is a range between a significant swing high and swing low. So some examples of dealing ranges could be a daily profile, monthly dealing range, or the morning swing from when market opens to macro time. Those are a couple examples of significant swing highs and swing lows. Or it can be like a big move or run in the 4 hour, 1 hour, or 15 minute. So step one is identifying the dealing range. You want to identify where did price expand from, what is the current swing high and current swing low. Step two is actually drawing out the premium and discount. As you can see right here, so 50% mark is going to be equilibrium. I will show you how to use this Fibonacci retracement. Let me get all the levels. So before you do anything, take a screenshot of my levels right here. You want 0, 1, 0.5, 0.25, and 0.75. Don't really worry about the 0.25 and the 0.75 right now. It's not that important. The main important ones is 0, 1, and 0.5. 0.5 is going to be your equilibrium. I'll just write that on here. EQ. EQ means equilibrium. Okay. So the way that you are going to identify if it's a premium or discount, you are going to put it on the swing low for a bullish move. Remember, bullish to the upside. You are going to put the 0 on the swing low and the 1 on the swing high. And the 50%, the middle 0.5, which is 50%, is going to be your equilibrium. Meaning, right here, we'll turn this green. Right here, turn this red. Meaning, on a bullish move, this is going to be our premium, okay? Because it's higher, and this is going to be our discount. So, if we're looking for longs, right? Let's get the arrows. So if we're looking for longs, let's say, bam, morning range is like this, right? And we have relative equal highs and a bunch of liquidity up here, but we have a fair value gap down here. I'll draw out the fair value gap. Okay. Actually, let me make it more clear. FEG. Okay. And your buy side liquidity is at these highs. The way that we are going to structure this is we don't want to buy in a premium, right? Because price could redeliver and offer price lower. So what we wait for is sit patiently, wait for price to come into a discount because we want to buy in a discount, and then form our entry model to the upside, taking out buy side liquidity. So to the downside, it's going to be pretty much the same exact thing, but it's opposite. When you are bearish, right, if you think the market's going down, you want to sell in a premium and then exit your position in a discount, right? So a bearish example would be we're coming down from price here, boom, straight shot down, right? So let's say This is our swing low and swing high, right? So what are you going to do? Put the 0 up there, the 1 on the bottom of the swing low. We don't need this as an example anymore. You already get the concept, okay? So this, let's say this is our dealing range, right? Swing high, swing low. You have relative equal lows down here. What you're going to do is wait for price to come into a premium because you're bearish now. So you want to buy high or sell high and get out the position low, right? Go like this. There's a fair value gap right here. Wait for your entry model in a premium, and then you're targeting sell side liquidity. This is basically premium and discount made simple. So now going into actual executions and actual examples of this, we can go on the 4-hour time frame, right? Okay. So going into the 4-hour time frame, you can see big move, right? So this is our swing high, and this, I mean, you can use either, but we're going to use this right now, right? Significant swing high and significant swing low. What you're going to do is grab your Fibonacci, which is going to be this tool right here on TradingView. It looks like 1, 2, 3, 4 lines, okay? And then you're going to put it at the swing high of the dealing range, and then also the swing low of the dealing range. Let me just make this way more clear for you. Bam. Okay. Now what can you see? This is our premium, and this is our discount, right? So discount and premium. Yeah. Okay. So now this is what market is going to look like by this point. There. So this is what market's going to look like, right? Swing high, swing low. But you're bearish, right? So if you remember, if you're bearish, that means you're going to take your entries in the premium. So as you can see, price retraces into the premium. This is where you find your model, right? And then from there, in a premium, wait for our model on a lower time frame, and our higher time frame sell side liquidity gets hit. Now let's find a bullish example on the 4-hour time frame. This is one right here, dealing range, bam. But let me find one that's way more clear for you. Let's see how far back we can go, because this literally happens on every single time frame. Obviously, I'm using it on a higher time frame and showing you examples like these, but still, this is what we want to use. Okay. So what do we see here? Swing low, major swing high, right? So before we can wait for price to go higher, we need price to offer discount, right? So once price is in a discount, that's where the banks can fill their sell orders and go long. Okay, so right here, swing low, swing high, this is a dealing range, okay? Wait for price to come into a premium, right? And then if I go to replay mode, bam, we're in premium right now. So we're not looking for anything. Drop down into a lower time frame. You can see we're in a discount. So now we have all this as buy side liquidity, right? We can go long now because we are in a discount. What do you wait for? Wait for an entry model. What do you see right here? Fair value gap with a change in state of delivery, which is basically a reversal to the upside. You can enter there, and then from there, it's going to take a while. We'll just go on a higher time frame. From there, price continues going up all the way up to 4 hour, back to 5 hour. Bam, 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 up to buy side liquidity. So this is it in simplest, like the most simple way that you can explain it, and fits perfectly into this model because you don't want to buy in a premium. So recap. You buy in a discount. If you're bullish, you buy in a discount and you sell in a premium. If you're bearish, you sell inside of the premium and then get out of your position in a discount. So common mistakes that a lot of people use is using random highs and lows, drawing the Fibonacci on a small intraday swing, and ignoring liquidity, right? So if you have equal highs and equal lows, like right here, you can see the swing high. Once it goes down to equilibrium, bam, bam. We make this intraday move, come down into a discount where the market is offering us to get in. And then now we have relative equal highs as our targets for price to go back up. So execution trade list is going to be what's my high time frame bias? What's the dealing range? Is price in a premium or discount right now? Has liquidity been taken yet? Do I have displacement? And is there an imbalance to enter if off of? The perfect trade is going to be, for a bullish example, an entry model in a discount. So if you understand premium and discount correctly, you pretty much stop chasing candles and you start trading in certain locations that has the highest probability. This is how institutions operate and how banks move. But that's going to be it for premium and discount. What I want you to do is go on the higher time frame, so daily, 4 hour and 1 hour, find the dealing ranges, and then go back in replay mode and notice how price moves from discount to premium. Okay.